161 tons has gone out of COMEX on that June contract. The next active contract is August. I suspect we'll have a banking crisis by then, but you can see that with that precedent having happened, I think we're likely to see more deliveries going through COMEX. My guess is that the people who are doing this are the wealthy, the people who basically have come to the conclusion that the system is basically broken. And what they should do is have some gold to protect their wealth. And they mean physical gold, not paper gold. So this is why we're suddenly seeing huge, huge volumes being exported into the United States. It's all going into lockup, basically. But I think the point I would make, if in a general economic sense, is that we're all looking at the virus. Don't forget that before the virus was even invented, the global economy was on a cliff edge. More than the whole of the US GDP is in foreign hands. That is a very weak position, and it is likely to drive the dollar down very substantially. The second phase is one that always happens at the end of a long period of inflation. And bear in mind that we're talking about a period which from certainly 1971, the dollar has lost 98% of its purchasing power measured against gold. So we've had a long period of inflation. At the end of that, there comes a point where the general public suddenly realize what's happening to their money. It's not a question of prices going up. They realize it's the purchasing power of the currency going down. Now, the moment the man in the street understands that, the currency is doomed because he will dump currency immediately.
Welcome back to Liberty and Finance and Reluctant Preppers. We have a returning guest who is anxiously awaited by our viewers. Alistair McLeod is the head of research at goldmoney.com. He joins us this Thursday, June 18th, 2020. Alistair, thanks for joining us again.
That's my pleasure, DK.
We've been speaking with you about once a month, and it's been about that long, and it just felt like so much longer. I was mentioning to you because so much has happened. Our world is just I feel like we're caught in a blender right now, and everything that we could have assumed as normal is gone. Everything that we thought we could hang our hat on as being reliable is unreliable. So you've written just very recently and currently about some major upsets that are going to be hitting us that are already in play, but that they just haven't played out. One of them is about a systemic failure in the banking system. You've brought up that topic with us multiple times, but it sounds like in your latest research, you really believe we're coming to a head here.
Yes, I believe so. If you look at the rating of the European banks, the British banks, the Swiss banks, the Japanese banks, the Chinese banks, they're all trading at very substantial discounts on a price-to-book basis. The American banks are trading just under price to book on average. So what this tells me is that the American financial markets, which we all follow, has absolutely no idea that there is real systemic risk out there. If you hold shares in Deutsche Bank or Banque Nationale de Paris or the Industrial Bank of China or Barclays Bank in the UK or whatever, you know that the rating that those bank shares have suggests that there is a lot of trouble within that particular bank. Now, so far, because the Americans haven't really recognized this, nobody's thinking in terms of overall systemic risk. It looks to me like there will be a bank failure. Now, the reason I say this is partly because of the ratings that the banks have been given individually in the market. But the other reason is that as the coronavirus lockdown continues, the bad debts are mounting, non-performing loans, and so on and so forth. And the clock is ticking on these banks who do not have sufficient capital to deal with the problem. Now, we don't know when we will have a failure, but the fact that nobody's expecting it almost guarantees we will have a systemic failure. And it's not just the GSIBs that I've been talking about, the global systemically important banks. Banks going way down the pile have big problems. I mean, we all know that there have been problems in the banking systems in Italy, Spain, Greece, and so on and so forth. But it's actually all around Europe. And the banks in Germany, particularly Deutsche Bank and Commerzbank, really look as if they are walking wounded. It will not take very much in terms of renewed bad debts, if you like, from the non-financial sector to undermine those banks fatally. So I'm not saying that those are the ones that are going to go. But what I'm saying is that there is a lot of trouble out there and nobody is looking at it. We're just looking at the virus and hoping that we will recover. But actually, that's just deflecting our attention from the really important things that are going on.
Right. When you said nobody's looking at it, I think what I would characterize that is the popular mindset is not being acknowledged to look at it, or not being directed to look at it. But we have this body language and overt statements by the Federal Reserve, for example, and the U.S. Treasury saying we're ready to tap unlimited funds to address whatever issues arise. So how does that story play out if something is fishy in Denmark? Something's terribly wrong here and getting worse that's going to come to a head in the next, say, month or so. But you've got the powers that at the spigot of these U.S. central banks saying we're standing ready to unleash unlimited support, not only domestically but internationally.
Yeah. Well, firstly, they're not going to say anything about systemic risk. That is a given, if you like. The problem that they have is that the Fed can only inject money, if I put it that way, into the non-financial sector through the commercial banks. The commercial banks, after a decade of credit expansion, their balance sheets are maxed out. They are now switching from greed of making more money, more gearing, more money, to fear. And that fear is increasing by the day. What it means is that the money that the Fed wants to inject into the non-financial sector of the economy is not going to be transmitted easily through the commercial banking system. And this creates another problem, and that is that you've got supply chains which have been disrupted. Now, the total value of US supply chains equates to gross output, and gross output of the US is $38 trillion. That is the extent of supply chains feeding into products and services in the United States. On top of that, there are supply chains outside the United States feeding in part processed manufactured goods for yet more processing.
Sure.
That's probably another 20 trillion. So we're looking at figures around about 50 to 60 trillion of supply chain payments in a year. Now, I doubt that all those are in trouble. But if we make a rough assessment that's onshore, you could be looking at somewhere between, 10 and 20 trillion of those in trouble. You can see how you have got debts mounting up at the banks from these businesses which are not getting paid because of supply chain disruptions. And when I tell you that the globally systemically important banks in America, their total market capitalization is less than $1 trillion, this sort of $10 to $15 trillion problem is really life-threatening as far as the banking system is concerned. So how do the Fed deal with it? I'm not too sure. I can see that the biggest companies would probably have some sort of bailout. Now, they can't really have a bailout from the Fed, but they could probably get it from the Treasury, which would be, the money would be supplied by the Fed, if you like. So that is a source of inflation. Now, I think one of the keys in all things, there's so many aspects of this which are nasty, they really are. But one of the key things, I think, is that if we do have a systemic failure, as I have suggested, then that changes everything as far as markets are concerned. I would see equity markets go through the floor. I would see foreigners' assessment of the prospects for the dollar change radically. They are no longer automatically buying US treasuries with the money they earn, if you like, from their net exports to the United States. They are beginning to sell those down. That is going to continue. Now, sooner or later, that is going to upset the financing arrangements of the US government. At the moment, with interest rates where they are, their annual bill is around about, interest rate bill is around about 400 billion, which is it's about 40%, if you like, of what was planned to be the deficit this year.
Just another sign of the times is that hurts my feelings that I even think, oh, that's just peanuts, that's just pocket change. It's like, for crying out loud, no, it's not.
No, it's not. It's very serious. But now think what happens if the foreigners are no longer funding it, funding government debt, and they are turning sellers, stock which has to be absorbed in the domestic system, probably by the Fed. And at the same time, you have got the concerns, if you like, mounting about the increased deficit that the US government faces in these conditions. You can see that if the Fed is going to manage to keep, it's almost impossible for the Fed to keep interest rates where they are. Bond yields will have to rise. And if they don't rise, the dollar collapses. So whichever way it goes, I think that the dollar is in trouble, which is why the article, which is due to be released today, which I think when you release this, which you're saying you're planning to do early next week, will be already on our website. So anyone who is interested, go to Go Money Insights, and you'll find my most recent article on that. I have written about this, and I hope that it makes it clear for anyone what the real dangers are as far as markets and the dollar is concerned. And I don't think I've ever seen a situation where, we stumble along thinking that everything's all right, but actually the banking system is so obviously in dire trouble. And when that falls over and the banks have to be rescued because they cannot afford not to be rescued, then I think it's a completely new ball game as far as the dollar is concerned and as far as the interest rate outlook for government bonds is concerned. Now, as soon as you start talking about government bonds beginning to yield what they should yield, and we would start at something like 3, 4, 5%. And as food prices rise and as the dollar gets dumped, we're probably talking even higher levels, this going beyond the control of the Fed, then self-evidently the US government is in a debt trap. And it's not just the US government, UK government, the ECB, all those governments in Europe, Japanese government. Finally, a lot of string is going to start unraveling. So I think this is a very, for an economist, interesting time, but very dangerous time.
When you talked about the U.S. debt should be priced in the 3 to 5%, do you mean in natural acknowledgement of the inherent risk that it's mispriced because it's implied that there's no risk there because it's at slow, low interest rate?
It's at the moment we live in a fiat currency world. So if you ask that of an economist or someone in the finance industry today, they would say U.S. Treasury debt is the least risky investment. It is, if you like, the zero risk standard. And indeed, the whole of the banking system works on that basis. All bank regulation works on that basis, that government debt in whichever currency is no risk. It carries no risk other than price risk. So I don't think it's that, really. I think the problem is that we know that the rate of inflation in America and in other countries is understated by the consumer price indices. You're fortunate in America, you've got two entities who actually analyze these things properly, Shadowstats.com.
Whom we're having on the channel? Yes, go ahead.
Well, and the Chapwood Index. The Chapwood Index, I think, is every half year or something. But John Williams, he does a very good job of showing, really, how understated the CPI is. We've got no equivalent of that in this country or in Europe. We just assume that the CPI is right, but it's wrong. John Williams' figures, I think, suggest that the rate is nearer 10% than 2%. The last Fed statement was that it was well under 2%. Well, I mean, I can certainly understand that when you shut down the factories and you stop people going out, they're not going to be buying anything, nothing's going to be made, nobody's going to have any money. Yeah, prices are going to go down. But some prices are going up, and they're the ones that matter, like food. Is the cost of accommodation coming down? No, it's not.
Medical.
And and medical and so on. So, it's the necessities of life are still going up in price. And in any event, I think to look at a price index, you cannot actually measure a general level of prices. It's a concept, if you like. The idea of measuring it is complete baloney. Your experience of a general level of prices is completely different from mine. So whose is right? Neither of us, because everybody has a different, if you like, take on how prices have changed as far as they're concerned. You can't average it. It's a complete nonsense. So I think, coming back to your question about yields, it's really going to be initially about foreigners dumping dollars, which they're going to be doing at an increasing rate. Now, it's interesting to note that Steve Roach of Harvard, who used to be Morgan Stanley, I think, he came out with a statement about the dollar saying pretty much what I'm saying. So what I'm saying is now beginning to be recognized, I think, in more mainstream avenues as a real risk, if you like.
You've spoken about the risks inherent in the banking system and the interdependencies that are present there, the structural, basically a house of cards or a set of dominoes that are all set up, that if you get a major disruption of any one of those banks, it will have ripple effects on the others. And you've also spoken about your concern about the coming specter of runaway inflation and how it has affected other currencies in the past and likely to affect ours. How do you see that playing out? I know that it's difficult to predict because it could go in different directions, but what are some major potential, what you consider to be credible risks that people should be aware of before they set their plans on where they want to shelter their funds or try to position themselves to minimize the damage on their family and on their future?
There's so many answers to your question. I think I would start by saying that what the American government and the Fed are doing is exactly the same as what John Law did in France exactly 300 years ago. I think we've had this conversation.
Yes, that's right.
Really what the Fed has done is it's tying in the future of the dollar to the future of financial markets. I mean, just imagine, let us say, I'm right about what's going to happen, that you've got a banking crisis, changes the whole scene. That leads to foreigners basically becoming autarkic. They go back in on themselves. They take money out of foreign enterprises, foreign entities, foreign portfolios, foreign bonds, and they sell those in order to bring money back home where it's really needed. The dollar is the one currency which is really exposed to foreign selling.
This is if we could just hold on that one point, because we hear almost the opposite, and I'm perfectly sympathetic to what you're saying, but we hear almost the opposite, that when there's a increase in anxiety and panic about the health of the banking system and currencies in general, they're all bad, they're all fiat currencies, there's nothing behind any of them, but there still will be a rush to the dollar and people wanting to grab onto the dollar because it's going to be considered the standard or the one that you can most recognize, most reliable. So that almost is at odds to what you're describing there.
I can explain that very, very simply.
Please.
What people are confusing is liquidity. If you are in dollars and you have no dollar liquidity, you have got a problem. You will sell assets to get dollar liquidity. If we had continually expanding trade, which was the situation before the trade war with China started, which I'm very sorry to say was your glorious presidents.
Yeah, you warned it. Yeah, we have an interview with you a year and a half ago saying trade protectionism at the top of the credit cycle. So yes, go ahead.
Yeah, absolutely. We now have contracting global trade. There is less need for foreigners to hold dollars than they held yesterday. Now, they will have liquidity requirements. They will make sure they've got liquidity requirements. And in very rough terms, there's something like $4 trillion worth of foreign-owned deposits in the American banking system. This goes through the correspondent banking system, which all clears in New York. So they've got the liquidity. Some of them might not have it. Some have got too much liquidity. But the one thing they've also got is they own an awful lot of stocks. They own an awful lot of bonds. And it's those that will get sold down. And when they're sold down, then what happens is that they will sell the dollars in the main. Some dollars may be just banked. But in the main, there will be net sellers of dollars. On top of that, you have a trade deficit, which I think in the month of March was around about $44 billion. What do the foreigners do with $44 billion they gain through net exports to the US? Well, they started selling them. It's as simple as that. And that was the month when the trade-weighted index for the dollar peaked, and then it fell very quickly by about 5 or 6%. It's recovered a little bit since, but not much. So you're beginning to see those selling pressures mounting on the dollar. So getting back to the original point you were making, don't confuse liquidity with ownership. They're two completely separate things.
You've written just now about the March was the month when everything changed. There's specific dates within there, and you just mentioned one critical thing that happened in March. Why is March 22nd to 23rd the time when everything changed?
Well, it's interesting because a number of disparate things happened. And it's rather like, when the seas come in and the tide has reached its height. And you know that because you look back and you see there's a bit of wet sand there which wasn't there before. Yeah, right. That's roughly the process.
The high water mark,
which I used. Yeah. Now, on the 22nd and 23rd, 22nd was a Sunday. So some of these things happened, if you like, in the late evening as far as you were concerned, but it was morning trading in the Far East. So I think the first thing that we noticed was that the trade-weighted dollar index actually peaked at that point, and it's been downhill ever since. As well as that, the S&P reversed its 30% fall, and it's now recovered all of that and then a little bit more. Other things, gold, after that massive sell-off, which was induced by the problems on COMEX, recovered. The gold-silver ratio recovered from 125, it's currently standing at 98. The price of copper has soared. Dr. Copper, the one base metal that everybody reckons is the biggest sign of what's going on. The oil price bottomed at that point. But in the case of the oil price, you had the fiasco the next month in April when the delivery mess in the futures market actually drove the price negative very, very briefly. So all those things happened at the same time. And there are either one of two interpretations. The one is that the recovery in the S&P and the recovery in the copper price and also the oil price subsequently, once it's settled down, all indicate that all our problems are behind us. We're going to resume economic growth once this coronavirus is out of the way, and life goes on. Wonderful. The other possibility, which is signaled by the dollar's peak on the trade-weighted index, is that actually what's happening is it's the dollar going down in its purchasing power, not a question of commodity prices going up. And because it's the dollar going down, that does indicate purchasing power of the dollar is falling. And with that falling, we have got an inflation problem. I put that in inverted commas. Prices rising, if you like, are already beginning to feed through, which is a completely different interpretation of the events. But you can see that everything came in to that date, around about the 23rd of March. And I've put a chart in that article which shows everything converging onto that date and then doing that. It is quite extraordinary. And I think if the current events lead to the destruction of the dollar, I think we will look back on that date as being the clearest signal that this was about to happen.
You mentioned in passing here that the falling value of the dollar is reflected in many commodities. Can you talk to us about the metals market, specifically gold and silver, what you think is going on, the dynamics that are affecting them?
Yeah, basically, well, if we start with gold, we can see that there has been a real problem in the paper markets. There is very, very little free bullion in London. I mean, the LBMA tries to tell us there's 8,000 tons. Yeah, but it's all pre-owned. I mean, there's quite a bit of central bank gold stored at the Bank of England. But when you look at the leasing rates, they're negative. And I think the Bank of England would have a problem trying to get, sort of foreign banks which have stored gold with it, foreign central banks which have stored gold with it, would have a problem to get them to lease gold with the way rates are. The Bank of England would have to come up with something very, very special. I think gold has been leased out of London, which has provided liquidity. But in terms of how much bullion there is out of that 8,000 odd tons, 8,300 tons, how much is actually available, I would put it at less than 500 tons, and probably considerably less than 500 tons. So that's the first problem. Second problem is that people are actually taking delivery on COMEX now. The last contract, which was the June contract, which expired at the end of May, so far roughly 161 tons has been delivered. Now that's never happened before. You get the odd person takes delivery on a COMEX contract. It's generally reckoned to be an expensive way of doing it. And in any event, the players there discourage people from taking delivery. What they would rather do is there was the exchange for physical facility, use that, or, and therefore shut the problem off to London. Or alternatively, I think that banks just lean on their customers and say, well, this is not making life easy for us. And if you insist on taking delivery, then I'm afraid you won't be dealing through us again. I think there's that sort of attitude. Despite that, 161 tons has gone out of COMEX on that June contract. The next active contract is August. I suspect we'll have a banking crisis by then, but you can see that with that precedent having happened, I think we're likely to see more deliveries going through COMEX. My guess is that the people who are doing this are the wealthy, the people who basically have come to the conclusion that the system is basically broken. And what they should do is have some gold to protect their wealth. And they mean physical gold, not paper gold. So this is why we're suddenly seeing huge, huge volumes being exported into the United States. It's all going into lockup, basically. Silver is interesting. On the 23rd of March, as I said, the gold-silver ratio reversed. On the chart, I show it actually as the silver-gold ratio. So it literally goes down, bottoms on, I think in fact, it was the Friday before, so it would have been the 21st, at 125, gold-silver ratio 125. Then it shot up to, it's up to about 98 at the moment. So that recovery is now happening. I think the point about silver is as much money as gold is. And it is the money, if you like, for general circulation, let me put it that way. So I would expect to see silver, the gold-silver ratio, go back down to levels that would reflect that. And there would be no exaggeration to say that if that is the case and fiat currency is effectively gone, then we're looking at gold-silver ratio somewhere under 20 eventually. Well, if the collapse in fiat currencies is happening as I suggest in my article, then it could happen very, very quickly.
Wow. Related question here from Chris Williams, who says, have the recent imports of gold to the U.S. been in order to settle COMEX or to top up U.S. reserves for some future reset?
No, it's been COMEX. Just as I've just described. You have got people who are standing for delivery because they want the physical. They are frightened by the current situation to the point where they want physical.
The scale on which that is happening hasn't been able to completely break the connection between the paper price and the physical price, although we certainly have seen a significant separation. Premiums have increased dramatically for those who want to obtain investable metals physically. They're having to pay a significant price, a premium over the spot price. There's a question from Silver Slave 333 who says, why doesn't a billionaire demand delivery of enough silver to break the manipulation?
Why not? I think it's wrong to look at it in the way, to break manipulation. Nelson Bunker Hunt and his brother tried that back in, I think it was 72. Yeah, around 71, 72, I think. And basically the system screwed them and it broke them. And that was the last time this happened. And I think that anyone with really serious money learned the lesson from that, not to try that sort of tactic. So that's why nobody's going to take on the system in the way in which you've just described.
Like throwing yourself in front of a tank.
Yeah.
OG, and I preface this with, you've mentioned in the past, as far as hedges against systemic risk, physical precious metal being one, you've said several times, perhaps crypto could be another ally in being outside that systemic system that's failing right now. OG says, I have a question for Alistair. Considering that Ripple is positioned to replace SWIFT and the XRP ledger is being adopted by all financial institutions, would you suggest XRP as a hedge against the inflation along with precious metals?
I don't know enough about it to make that recommendation. But what I would say about crypto is that once fiat currency is gone, crypto doesn't actually have a role in the sense of being money. If you look at Bitcoin, for example, what are you going to price Bitcoin in? Once fiat's gone, you're going to price it in gold, which is the more volatile Bitcoin. So what are you going to do? It may go up against gold, really doesn't matter. But when it comes to money, using it as money, I think it will not have a function as money. There is no doubt in my mind that we will revert to metallic money, gold and silver. I can see the role for Bitcoin as a hedge against failing fiat, but that is the extent of it. I can't see how it goes any further from there.
You're saying as a replacement for currency, for a medium of exchange?
Yeah, yeah. I mean, the way in which it is being viewed, I think, by its owners is that Bitcoin and presumably similar restricted issue cryptocurrencies are safer than paper money, because paper money is being printed at will. And the thing that's fascinating is that the invention of these cryptocurrencies has educated a whole swathe of people about what government are actually doing with their money. We haven't seen that before. It could actually hasten the process of the collapse of fiat currency, because you've got all these people in the crypto market who know what government are doing. But nobody's looking beyond the fiat currency situation. And I think that's really going to be the very interesting question. I am absolutely certain in my own mind that the better money in terms of transactions and all the rest of it is gold and silver rather than crypto. So crypto then becomes a store of value. It remains as a store of value. But against what? Against gold? I think it then becomes almost redundant, if you see what I mean. Now, the technology could well be part of the solution, but it would be a solution of providing substitutes for gold and silver, if you see what I mean.
On a transactional basis.
Well, fully backed, fully backed substitutes for gold and silver.
Your scenario that you described, you've looked at the financial aspect, you looked at the health of the banking system, you looked at some systemic clues that are happening in interest rates and commodities and that sort of thing. The macro environment, at least that our attention is being directed to as a populace by mainstream media and by government sources and everything, is over towards health concerns or policy responses to that and that sort of thing. Some people are really concerned that that has an agenda driving it, and that could result in a second wave of restrictions that could cramp down the supply chains again in the next few quarters. One question, this is just a random one, but it's one that I think at a common sense level, people are asking themselves and each other to try to separate the wheat from the chaff as far as what's really going on. Silver Slave 333 says, does Alistair personally know anyone who has coronavirus?
Or had? Yes, is the answer. Yeah.
Okay.
A sister of a friend of mine who was seriously ill with it. My eldest son's partner had it. I think my eldest son had it, but he didn't show any symptoms. And there was one person in the village here who had it, apparently, but not someone I knew. So there are a few of them around. I mean, it hasn't been perhaps as bad as this, all the lockdown would suggest. But having said that, we don't want to mix cause and effect. The reason it is not worse, probably, is because of actions that governments have taken, particularly in places like Italy, the UK. I think the US is a bit variable, really, in a sense, from what I can gather. But I think more worrying is that there seems to be a second wave starting in Beijing, which whether we should really worry about that or not, I don't know. I mean, certainly the Chinese authorities, I think, have been far smarter in handling the second wave than they were the first time round. They, I think, have learned that it's more important to control the virus rather than control the news. But we'll see. I mean, it's not gone. And I think the point I would make, if in a general economic sense, is that we're all looking at the virus. Don't forget that before the virus was even invented, the global economy was on a cliff edge because of the long period of bank credit expansion, which was running out of steam, and the trade situation between America and China had actually stopped the growth of global trade, and it was beginning to contract, so much so that countries like Germany, whose major customer is China, were driven into recession in the last quarter of last year. So it's not just coronavirus. This is something far deeper.
Yeah, and we had evidence something far deeper was going on with the repos that started in mid-September. We had even you mentioned the supply chain disruptions. We had a insider in the U.S. trucking industry who works at high levels. He was with us at the very beginning of Q1 talking about how they had been seeing huge disruptions in their forward projections of volume for 14 months. He said they tend to be a leading indicator, and so we called that interview economic red alert from inside the trucking industry, and it certainly did play out, and all of that predated anything having to do with an illness. Now, if we could talk back just one more question at the end here about the timeline that you foresee. You have been talking for some time about concerns about the health of the U.S. dollar. Rusty Shackelford brings it right home, and I think you've touched on this. Are we going to have a fiat collapse by the end of this year?
In my view, yes. It may be delayed by a reset or an attempt at a reset. But putting that to one side, you've basically got two phases in the collapse of a currency. The first phase is usually driven by the foreign exchanges. And we've just been talking about the foreigners' attitude to dollars. They have got something like $25 trillion in terms of valuation, if you like. That's a mixture of securities, short-term securities like treasury bills and so on and so forth, and bank balances. So you can see that more than the whole of the US GDP is in foreign hands. That is a very weak position, and it is likely to drive the dollar down very substantially. The second phase is one that always happens at the end of a long period of inflation. And bear in mind that we're talking about a period which from certainly 1971, the dollar has lost 98% of its purchasing power measured against gold. So we've had a long period of inflation. At the end of that, there comes a point where the general public suddenly realize what's happening to their money. It's not a question of prices going up. They realize it's the purchasing power of the currency going down. Now, the moment the man in the street understands that, the currency is doomed, because he will dump currency immediately, rather like, the Venezuelans. I mean, that's the reason there's so much currency around. Nobody wants it. That is the final stage. And in the past, it has taken roughly 6 months for that final stage to occur. Now, I don't know whether the March 23rd date that I've identified sets the clock for a 6-month collapse in the dollar. We will only know after the event. Also, the other thing we could say is that the fact that people are more savvy nowadays about what's going on in the dollar, they've been educated by cryptocurrencies, that could speed up the rate of collapse. Communications today are so much better than they've ever been in the past. So if you tell me something that really matters financially, I know it, and it gets passed everywhere, by all of us. Mm-hmm. It's like wildfire. And the last point is that in the old days, I mean, if you look at the German inflation, which again took roughly 6 months from May 23 to November 23, in those days, you would get paid, and you would get paid in cash. So you had to wait to get paid in cash, and then you'd run around to the shops and you'd spend it in the shops. Alternatively, if you draw a check on your bank account, it took 3 days to clear. So this slowed down the whole process of the collapse of the currency, as you may imagine, because you had this physical thing. Nowadays, you just press a button, bang, gone. Who's going to hold it? And this is the other problem, which nobody really, I think, fully understands, and that is that if we all at the same time decide that we don't want the currency, we're all sellers of it and buyers of something else. So are you going to want my dollars? No. So you're going to raise the price of your goods to compensate for your desire not to own any dollars. And so you can see how rapidly this thing can go. Modern communications are a big, big difference from the past. So this could actually happen very quickly.
Perversely, modern communications where things can spread like wildfire are also a tool used to maintain the public awareness or lack thereof by the powers that would like to keep us distracted. So it's kind of a titanic struggle between forces using that new medium, but it can cause a lot of volatility as those forces vie. Well, Alistair, it's been excellent having you on. There's so many more questions. I maybe I can just sneak one more in on you here. This is a question about, you mentioned other things that people might want to put their value in other than currency. Joachim Saxon says, how do you see the price ratio between precious metals and productive land develop during a currency collapse?
Well, we've got lots of form on this, and that is that the price of productive land measured in gold or silver actually goes down very substantially. The reason is simple, and that is everybody needs to sell whatever they've got in order to survive. So you've got lots and lots of sellers. And the way in which people make money out of a currency collapse is by being able to borrow worthless currency at whatever interest rate. Really doesn't matter, because they know that when they have to repay, the principal is gone. And the best example of this was back in 1922-23. There was a chap called Hugo Stinnes, who was known as the inflation king. This was in Germany. He acquired fully 1/4 of the whole economy, basically, by using the collapse in the currency to do so. He bought country estates, he bought factories, he bought property and all the rest of it. And the key to this is don't buy financial assets. What you do is you buy real assets in depreciating currency. To put it another way, with $100, which were gold backed at that time, you could have bought a mansion in the swankiest street in Berlin. I think that answers the question.
Well, we're delighted for your presence here, Alistair, and thank you for joining us on Liberty and Finance and Reluctant Preppers. And people can look for your articles. They'll find them at goldmoney.com.
Goldmoney.com under Research and then Insights.
Research Insights. Okay.
And I also do a market report on Fridays, so I'll have one out sort of late afternoon your time Friday.
Very good. Thank you so much, Alistair.
That's my pleasure, DK.
you've decided that now is the right time for you to protect your family's financial future by acquiring physical precious metals, gold and silver, I'm delighted to let you know that I have now become a licensed dealer's representative for Miles Franklin, one of the oldest and most trusted names in bullion dealerships. And we can provide you with physical delivery to your personal possession or to professional vault storage or precious metals IRAs. Just email me at libertyandfinance@protonmail.com, and please include your name and phone number in your email to libertyandfinance@protonmail.com. We'll get right back with you and find out how to best meet your needs so that you can either begin or increase your acquisition of physical precious metals now and protect your family's future starting today.